All right, so like I was mentioning, we're going to be focusing on a business-to-business transaction, right? One business selling merchandise to another business. It's very important that you understand how to read an invoice to understand all of this. Because on an invoice, you know that there is a buyer and there is a seller. So in this case, PW Audio Supply is the business that sold the circuit board and circuits to this other business called SOC Stereo. SOC Stereo. That's a business-to-business transaction. Learning objective 2 is going to look at this transaction from the buyer's perspective, okay? Which in this case is, how does SOC Stereo look at this transaction? And we're going to be doing the books for SOC Stereo. Learning objective 3, the next one, talks about the same invoice, but from the seller's perspective, PW Audio. Okay, so let's take a closer look at this invoice, just so you know what's important here. You know the seller, you know the buyer. Of course, in accounting, you know, everything is recorded chronologically. So you got to know the date that stuff happened, right? So the date is super duper important. We don't necessarily have to need to know the salesperson, although they probably work on commission and would feel insulted that I said that. But nonetheless, for accounting purposes, we don't need to know them. You do need to know the terms, which I'll get to in a moment, and what's called FOB, when the actual inventory changed ownership. Okay, so let's take a look at what PW Audio sold to SOC Stereo. They sold one circuit board for $2,300, okay? And they sold 5 circuits for $300 each, for a total of $1,500. So the total amount of this sale is $3,800. Now again, PW Audio sold it. So PW Audio owns this inventory. They own the inventory, right? The question becomes then, when does, and SOC Stereo is the buyer, when does SOC Stereo own this inventory? When do they own the merchandise that they just bought? Well, that's what this tells us. FOB is really the point of ownership. FOB shipping point means, as you'll see in a nice graphic later, at the time it gets, it's given to the shipping company, whether it's the Postal Service, UPS, FedEx, what have you. As soon as it's given to the postal company, that is the shipping point. And at that time, the ownership goes to the buyer. Okay, so in this case, since PW Audio is in Michigan and SOC Stereo is in Illinois, they're going to have to ship this thing, or these things. So as soon as they put it in a box and give it to the shipping company, then SOC Stereo owns it. Now, because SOC Stereo owns it, they own it as soon as it gets to the, you know, to the carrier in Michigan. They're going to have to wait for it to get shipped to physically have it in Illinois, but they own it all that time. That's still their inventory. That's still they own. That's still their asset. All right, so let's go back here to the total. This $3,800 is the total sale that was made from PW Audio to SOC Stereo. But this $1,300 is also the cost that SOC Stereo incurred to buy the circuits and circuit board. Okay, so this is going to be a very important number that you're going to see. We will get to the terms in a moment. An invoice means that for the company, PW Audio, who sold it, this invoice will be shipped with the merchandise, which means that they haven't gotten paid yet. They're waiting to receive payment. So this invoice to PW Audio is an accounts receivable. SOC Stereo is going to open up this box with an invoice. to Sock Stereo, this invoice has to be paid. And so it becomes a payable to Sock Stereo. So to the buyer, it's a payable. To the seller, it's a receivable. Okay. So this is the information that's very, very important on the invoice. So because it's a payable to Sock Stereo, when do they have to pay it? That's what the terms are for. The terms here are indicating that if they pay, this is what we call 210 net 30, pretty common. If they pay within 10 days of when they bought it, that's the date, they can take 2% discount. They can pay 2% less. If they don't pay within 10 days, the whole amount is due in 30 days. The net and is net 30. The whole amount is due in 30 days. So this is why the terms are important. They're important to both Sock Stereo to know they'll get a discount if they pay within 10 days, or if not, they owe the whole thing in 30 days. It's important to PW Audio because they want to give an incentive for Sock Stereo to pay them early, so they give them a little discount if they pay quick. If not, they'll take the whole thing later on. Okay, so as you see, it's a one invoice, but wow, what a story. What a story, right? And so we're going to start looking at this invoice from Sock Stereo's perspective. So let's put on a hat of Sock Stereo's bookkeeper. And Sock Stereo just bought this. You're the bookkeeper for Sock Stereo. You're looking at this invoice. What do? Well, you got to put it into a journal entry. Again, they bought it on May 4th. So of course, you know it's chronological. They bought $30 to $100 worth of inventory. So inventory is going to increase by $30 to $100. And of course, they just got an invoice, which to Sock Stereo is an accounts payable. So this is the first thing you have to know. When you're buying merchandise, business to business, debit the inventory because it's more inventory, right? Inventory is an asset. They just bought more of it. Accounts payable, liability. They owe this money either in 10 or 30 days, their choice, but they owe it, okay? So that's how that starts. This wonderful illustration shows what I was trying to explain before. This is the most common term, FOB shipping point, in terms of when ownership passes to the buyer. So again, the seller is PW Audio. They're boxing it up and giving it to the carrier to deliver to the buyer. As soon as they give it to the carrier, at this point, ownership goes to the buyer, which means the buyer, since they own it and it's on a truck or whatever going to them, they're going to be paying for freight and insurance. They're going to make sure their inventory is safe and covered. The other possible option is something called FOB destination. It is used on occasion, although it's not as frequent. FOB destination is just the opposite. The ownership doesn't transfer from the seller to the buyer until it gets to the destination, right? So in the case of Sock Stereo, who is in Illinois, that merchandise would have to go get all the way to Illinois and get dropped off at their location for them to actually say, we own it. Which means that the seller, even though they don't have the merchandise because they put it in a box and put it on a truck, guess what? They still own it until it gets to that destination. And so the seller, because they own it, is going to want to make sure their inventory is protected. It's an asset. So they're going to pay for the freight and insurance and make sure it's all set. When the seller, by the way, pays for freight, it's simply an expense. And we'll see that coming up soon. But again, our focus is on the buyer. So here we have the delivery of the goods happened the very next day, I believe, or within 2 days. And Sock Stereo has to pay $150 for the freight charges. So what's the journal entry on the books for the 6th of May for these freight charges? Well, you have to go back to chapter 2 when we were introduced to some GAAP standards. One of them is the historical cost principle, which says that assets have to be recorded at their cost. Okay. So inventory is an asset. So you paid so much for your inventory, but now you also paid for shipping of that inventory. So how much did the inventory really cost you? Well, it really cost you the price of the inventory plus the shipping of that inventory to get it to you. It's almost like watching, a commercial that has a product you want to buy for 20 bucks, but then you have to pay shipping and handling. And I ask you from a financial perspective, how much did that cost you? Well, you could say 20 bucks, but you're lying. I'm just joking. You can say 20 bucks, but you'd be misinformed, right? Because it didn't just cost you 20 bucks. It cost you 20 bucks plus, say, $5 shipping. So it really cost you 25 bucks. Well, in accounting, we have to show that's the real value of the asset. So here, even though we paid 150 for freight, we are going to debit inventory for that 150 because literally we need to show that we paid more for the asset. Okay, so that's something that's important to note. Again, when the seller pays, it's just an expense. And here's a new expense account for you. Freight out is actually an expense account. So that's something new. You've already learned a couple of new accounts already, and there's more coming. Damn, it's going to be very exciting tonight. So this is something you don't have to worry about unless you're on the seller side and you pay for the freight. Well, you know how it is when you get a box of goods in the mail, you open it up and like, shit. Oh, I like this. I like this. I sure don't like this one. So you can return stuff. Same thing, business to business. It doesn't really matter who's buying, who's selling. There's returns that are involved, and they're reasonably common. Normally speaking, when the purchaser is some way, shape, or form dissatisfied, normally it's quality. Normally it's I bought the wrong one, or it doesn't meet the specifications. Very rarely is it defective. Very rarely. Or damaged. They're pretty good at packing and shipping today. It's amazing what they can do. So it's unlikely going to be those two, but it's possible. So normally speaking, the buyer just ships it back. Okay, I don't want it, send it back. Sometimes they're like, well, look, it's not the type of quality I need, but if we can cut a deal now for a lower price, I'll keep the shit. I won't send it back. That's what a purchase allowance is. Returns are very, very common. Very, very common. Allowances a bit less so. Okay, so let's say Stock Stereo opened up that. They saw the circuit board. They were happy with that. And they saw all those circuits. And they said, I think we bought too many circuits. We don't need this one. So in this case, they're returning one of the circuits for $300. Okay, so what happens when they return a circuit in this case? Well, first of all, they are going to reverse the entry from when they bought it. So they're going to lower their accounts payable. The debit to accounts payable means I'm not going to be paying for that, so I need to reduce my payable. And they're sending back inventory, so they don't have the inventory anymore. So they're going to be lowering the inventory account by $300 every time they return. This is, again, from the buyer's perspective. Everything's about inventory. Your book goes ahead and explains about what we call a purchase discount. Purchase discounts only apply if the buyer decides to pay early and take the discount. It's good for the buyer to pay early because they save money that way. And it's good for the seller when they get paid early because they're not waiting for their cash. They're getting their cash quicker. So it's a win-win to provide other businesses that you do business with incentives to pay early, like a purchase discount. The most common one you'll see, and in the book as well, 210 net 30. There are others as well, but this is the one that we tend to use the most. So let's go back to our situation between Sock Stereo, the buyer, and PW Audio, the seller. Sock Stereo now has a balance of $3,500. Remember, they bought $3,000 worth of stuff, but they sent $300 worth of stuff back. So that's where the 3,500 comes from. Okay. And they have until May 14th to make that payment and take the discount. And so this assumption is, look, we're going to pay by the 14th. How do we do it? Well, they're gonna not owe the full $3,500, right? They're gonna have a 2% discount on that. So this is what it looks like in the books of the buyer when they pay for this. They're gonna say they paid their entire payable, which they did, $3,500, but they only paid $3,430 in cash because they saved $70 by taking the discount. Well, again, let's go back to historical cost principle. If I buy inventory and I then have to pay for shipping, that means my inventory costs more. Well, guess what? If I take a discount, that means my inventory costs less. Okay. And so the credit goes to inventory because it's saying, look, I paid less for my inventory because I took the discount. So inventory increases with shipping, decreases with discounts. What if they didn't take the discount and they waited until June? Simple. They debit accounts payable for the full amount, they pay cash for the full amount, and it's done. Piece of cake. Don't worry about those. And here we're at the end of learning objective 2. So this do it exercise, again, focuses on the buyer. And you'll see this same do it exercise again in learning objective 3, but from the seller's perspective. So let's take a look. On September the 5th, De La Hoya Company buys merchandise on account. Remember, on account, meaning you're going to get a bill, you're going to pay it. From Juno Diaz. The purchase price of the goods is $1,500. So that's what happened on the 5th of September. 3 days later, on the 8th of September, De La Hoya returns $200 worth of that stuff. They think it's defective. So you're the bookkeeper for De La Hoya. De La Hoya is the buyer. What do? Well, the first thing you do on the 5th is record the purchase of the inventory. So increase inventory with the debit, increase accounts payable with the credit. Then on the 8th, you're going to show you sent $200 back, and simply you're going to flip. You're going to decrease your accounts payable with a debit, decrease your inventory with a credit. And that is how the buyer looks at things.